Ever found yourself thinking, how do banks make money? Well, you're not alone. Banks are far more than just safe houses for our hard-earned cash. They are complex entities that play a pivotal role in the economic structure of our society. Understanding how they operate and generate revenue is crucial for everyone, not just finance enthusiasts. Banks primarily make their money in two ways: through the interest earned on loans they provide and the fees they charge for various services. When you take out a loan, the interest you pay is the bank's gain. And those monthly account maintenance fees? Yep, that's right, they go straight into the bank's coffers. But there's more to it than just loans and fees. Banks are masters of turning our money into their profits, and it's a fascinating process to delve into. So gear up for an insightful journey into the world of banking. Banks operate on a simple principle. They take in deposits and lend them out. At its core, this principle is what fuels the entire banking industry. Let's break it down a bit further. Imagine you've just received your paycheck and decide to deposit it into your bank account. That money doesn't just sit idle in some digital vault waiting for you to use it. Instead, your bank puts your money to work. The bank, like a diligent worker bee, takes your deposited money and pays you interest on it. This interest is a small token of appreciation for letting the bank use your money. While the interest rates may seem minuscule, over time, they can add up, helping your savings grow. Now, here's where the magic happens. The bank doesn't just hold on to your money. It lends your money to other customers, like individuals who need a loan to buy a house or businesses that need financing for their operations. And just like how the bank pays you interest on your deposits, these borrowers pay the bank interest on their loans. But here's the kicker. The interest that borrowers pay to the bank is typically higher than the interest the bank pays you on your deposits. Why is that? Well, the bank takes on the risk of lending money, and for that risk, it charges a premium. This difference in interest rates is known as the spread. The spread is where banks make their money. It's a delicate balance, a sort of financial ballet. Banks must attract depositors with competitive interest rates, while also lending money at rates high enough to cover their costs and generate a profit. So in essence, your bank is like a financial middleman, connecting savers who have money to lend with borrowers who need money. It's a win-win situation for everyone involved. Savers earn interest on their deposits, borrowers get the money they need, and banks earn profits from the spread. This difference in interest rates forms the backbone of a bank's revenue. And that, my friends, is the basic banking model in a nutshell. Banks don't keep all the deposited money in their vaults. Surprised? Well, it's true. This is where the magic of fractional reserve banking comes into play. In a nutshell, fractional reserve banking is a system where banks only hold a fraction of the total deposits as reserves. The rest, it's lent out to other customers. This may sound risky, but it's a carefully calculated gamble that has been the bedrock of the banking industry for centuries. Imagine a game of musical chairs. The deposits are the chairs, and the bank customers are the players. The bank only needs enough chairs for the players who are currently in the game, not for everyone who might potentially want to play. The rest of the chairs can be used elsewhere in the meantime. The same principle applies to fractional reserve banking. Let's delve a bit deeper. When you deposit money in a bank, the bank keeps a small portion, the reserve, and lends the rest to other customers. These loans then get deposited back into the bank and the process repeats. Each time the money cycles through, it creates more deposits, which the bank can then lend out again. This is how banks create money, not by printing new bills, but by making loans. And what's in it for the banks? Well, when banks lend money, they charge interest. The more they lend, the more interest they earn. This is how they make their money. And the beauty of it all is that this system works because we, as a society, have confidence in it. We trust that the bank will give us our money back when we ask for it. But what happens if everyone wants their money at once? That's a topic for another scene. For now, let's marvel at the magic of fractional reserve banking. So there you have it. Fractional reserve banking, a magic trick that keeps the banking world spinning. It's a fascinating system, full of intrigue and sophistication, just like a well-crafted magic trick. Banks have a not-so-secret weapon for making money: fees. Now, these aren't the kind of fees you'd expect to pay at a concert or a festival. No, these are the subtle, often overlooked charges that come with maintaining an account, using an ATM, or even going over your account limit. Let's start with account maintenance fees. Most banks charge a small monthly fee to keep your account open. It's like paying rent, but for your money. Then, there are ATM fees. Need cash in a hurry? That convenience comes at a cost. And let's not forget about overdraft fees. Accidentally spend more than you have in your account, and you'll find yourself paying for that mistake. Each of these fees may seem small on their own, but when you consider that a bank has millions, sometimes even billions of customers, they quickly add up. $1 from a million people is still $1 million after all. Fees may seem small, but when multiplied by millions of customers, they add up to a hefty sum. Banking isn't just about making money, it's also about managing risks. And these risks aren't as simple as a game of chance. They are complex, multifaceted, and require a delicate balancing act to manage. Let's start with credit risk. This is the risk that a borrower will default on their loan. To protect against this, banks conduct rigorous assessments of potential borrowers, evaluating their credit history, income, and other factors to determine their ability to repay. But even the most thorough assessment cannot eliminate credit risk completely. That's where diversification comes in. By lending to a wide variety of borrowers, banks can spread their risk. If one borrower defaults, the impact is cushioned by the repayments from other borrowers. Then there's market risk. This is the risk that changes in the financial markets, like interest rates or exchange rates, will affect a bank's profits. To manage this, banks use a variety of financial instruments, such as derivatives, to hedge against potential losses. They also closely monitor market trends and economic indicators to anticipate changes and adjust their strategies accordingly. Another key risk is operational risk. This includes everything from cyber attacks to human errors. Banks invest heavily in technology and training to minimize these risks. They implement robust security measures to protect against cyber threats and establish procedures to ensure that transactions are processed accurately and efficiently. And let's not forget about liquidity risk, the risk that a bank will not have enough cash on hand to meet its obligations. Banks must maintain a certain level of liquid assets and carefully manage their cash flows to ensure they can meet withdrawal requests and other immediate needs. All these risk management strategies are not just for the bank's benefit, they are also crucial for protecting customers' money. After all, if a bank fails, it's the customers who stand to lose the most. So while banks are indeed in the business of making money, they also play a crucial role in managing financial risks. They must strike a balance between their desire for profits and their responsibility to keep customers' money safe. So, banks are not just money-making machines, they are also guardians of our financial security. We've just taken a thrilling ride into the world of banking. We've uncovered the basic banking model, the magic of fractional reserve banking, and how banks turn that into profit. We've also been introduced to the risks and rewards of banking. Understanding how banks work is not just essential for finance students, but for everyone. It's all about knowing where your money goes and how it grows. Next time you walk into a bank, you'll know exactly where your money goes and how it grows. Stay tuned for more enlightening financial journeys. We hope you found this journey into the world of banking enlightening. We've tried to demystify the complex world of banks and how they operate, and we hope you now have a better understanding of where your money goes and how it grows. If you enjoyed the video, don't forget to hit the like button. Your support really helps us to continue producing content like this. And if you haven't already, do subscribe to our channel. We have many more enlightening financial journeys planned for you. And by subscribing, you'll be the first to know when we post a new video. In the world of finance, as in life, knowledge is power. So let's continue to learn and grow together. Thank you for watching and stay tuned for more. Remember, your financial journey is just beginning and we're here to guide you every step of the way.